Okay, hi everyone. Welcome to the Q4 webinar. Today will be myself, Mo, as per usual. And then please feel free to post any questions in the chat, and we can address them at the end when we have our Q&A section. Okay, so today we'll be discussing some of the key themes we've seen throughout 2025, and then with a focus on what happened in Q4 last year. And then we'll also touch on how the portfolio performed during the quarter, and then also our outlook heading into 2026. So looking at the macro picture, interest rates were quite a key talking point. In the last three Fed meetings of 2025, we saw Chairman Powell make three consecutive 25 basis point cuts. And this was after receiving a lot of pressure from Trump, kind of slated him on social media, calling him a lot of different names. And then, yeah, after 10 months of not cutting, he finally did cut and then had three in a row. So it's quite a pivot in terms of his policy. So Powell put these cuts down to a weakening labour market. But what this has done is caused some concerns over the Fed independence, as inflation does still remain very high and unemployment remains below historical averages. So since the last cut in December, markets are now anticipating no more cuts until the rest of Powell's term as chairman of the Fed, and this ends in May. So Trump has made it very clear that he does want low interest rates and has now put in pressure on Powell once again, but this time in a much more aggressive way, how he's kind of created criminal charges against Powell to try and intimidate him to lower rates, similar to what he did with Lisa Cook. So this has just created a bit of mistrust with the Fed independence and has caused the yield curve to steepen and then also the dollar to weaken. But when it comes to May time and Powell be kind of out of his position of power, Trump does have the ability to appoint a more controlling Fed chair, which could fulfill his long-awaited wishes of having low interest rates. He's even kind of given numbers of 1% interest rates. So this could kind of be very damaging to the long-term longevity of the US economy. So currently, markets paying close attention to see who he appoints, and we'd like to see some volatility in treasuries. Based on this, of what's going on in the US, kind of Fed independence, we've seen a reallocation of capital in 2025. There's kind of been a common trade of sell America, buy global, and then this is very different to what's happened over the last decade, where US equities have taken a lot of the global capital, and then now valuations are stretched. Investors start to not like Trump's style of uncertainty, and they're looking elsewhere for lower valuations and greater potential growth. So emerging markets was a popular trade. We saw frontiers as well, which I'll touch on later, Asia, UK, Europe. So it's just basically everything ex-US was a popular trade during 2025. And this theme kind of worked in our favor and led to our outperformance in 2025. So relatively good on our end. So yeah, this kind of reallocation out of the US was stemming from US exceptionalism, kind of came under pressure a little bit. But yeah, kind of on the surface level, the S&P 500 actually had a good year in dollars. It was up 16%, but it sounds positive, but it was actually a little bit concerning once you kind of look a little bit deeper into what other regions have done. And it's actually, relative to the rest of the world, 2025 was the worst year for US stocks since 2009. So quite a considerable change there in kind of global dominance in terms of stock market returns. But Trump does continue to say the US is the best stock market in the world. But in reality, the weaker dollar has benefited ex-US countries a lot more. But this has largely escaped the attention of many market participants. So looking at kind of economic growth as well, forecasts are looking very strong. A lot of the US major banks are putting out their 2026 forecasts, all looking very positive in terms of economic growth and stock market growth. But these forecasts can change very quickly. So yeah, it's not to say this is going to happen, but still AI spending remains strong, props up GDP growth in the likes of the US that have just had huge amounts of spending commitments kind of planned over the next few years. I'll now pass over to Mo to look at the Q4 stats.
Good afternoon, everyone. Thank you very much for joining us again. So just to follow on from what Lucas just said, with regards to the actual performance of the various markets over Q4, as we've shown before. So looking down on the left-hand column, you can see that there were reasonable returns from some markets. The Hang Seng, which represents China, came under a bit of pressure after a very strong Q3, where I believe it was up over 13%. And that also topped off what ended up being a very, very strong year for China. And we did touch on this in our previous webinar. So the Hang Seng in local currency delivered almost double the return of the S&P 500 in dollars. So no surprise that Q4 gave some of that back. And that had a small effect on our portfolios where we have some more Chinese orientated exposure. But overall, still a very good quarter for us, particularly from precious metals such as gold, which had another good quarter. Move on to the next slide. You can see that it was quite most returns, well, all returns were positive, although it was very choppy, and most of the portfolios ended up in about the same place, irrespective of equity level or risk level. So not too much to read into that this time round, and this again follows a very, very strong Q3. So no surprise that returns were a bit more difficult to come by, and were definitely choppier. However, if we move on to the next slide, what we can see here is that, as Lucas mentioned, our portfolios had a very, very strong year across the board, and this is just a representation of one of our portfolios, the growth portfolio, versus a bunch of sort of relative peers, some of the best sort of known names in the industry. So many of you would have seen this before, and that's how we fared over 2025. So a very good year for us, mainly because of the themes that we've talked about, certainly the last quarterly meetings, such as going overweight China, for example, our precious metal exposure, having a bit less in the US versus other regions, and having a bit more towards value-orientated companies versus growth. So the combination of those ended up doing very well for us.
Yeah, so I kind of touched on the earlier. Frontiers is one of a good region over 2025. It was actually the best performing region. It's kind of a group. For those of you that don't know what Frontiers is, it's basically one step before the emerging markets term in terms of development. But yeah, as you can see on the chart, the MSCI Frontier Index delivered a gain of 37% during 2025, which is very good. They presented a strong kind of valuation metric, very kind of cheap, as they were very out of favor just a couple of years ago. And one kind of interesting point to make was in the US, the last remaining Frontier ETF actually closed down in roughly November 2024, as it was just losing assets, wasn't making money, so they shut it. So this was kind of your initial contrarian signal. It's a good time to invest into frontier markets. And yeah, they performed very strongly during 2025 for a few reasons. Firstly, the weaker dollar kind of boosted frontier markets, made it more attractive in dollar terms. Secondly, kind of as I previously mentioned, there was a reallocation of capital outside of the US. We saw this kind of trend in 2025 as investors were looking for value. The regions that started the year with the lowest P multiples, we saw that finished the year with the strongest performance. So this included returns from Colombia, South Korea, Poland, and then the countries that started off with the highest P multiples lagged. So we saw this shift of value, and these kind of high P multiples were regions such as US, India, Denmark, and then yeah, as frontiers were trading very cheaply, it was a popular trade. And then final kind of point was there is very strong underlying fundamental growth in a lot of the frontier regions. They have favorable demographics. Their working population is very young relative to a lot of the developed economies, whereas aging. They also have expanding the consumer sectors with improving financial conditions. So it makes it a very attractive investment. And we were able to benefit from this bull run in 2025. We timed it quite well, whereas in January last year, we purchased the Red Wheel Next Generation Emerging Markets Fund. And this Red Wheel Fund, how it's kind of set up is it blends emerging markets with frontier markets kind of in a split. So it gives you a broader exposure to across nearly kind of 30 countries. And this fund is one of the best performing funds in the emerging market sector, as it has this kind of frontiers exposure, which is quite a niche thing we've seen. So yeah, the introduction of this fund did contribute quite positively to our performance. So all good news on that front. And then we'll now look at the UK market. So kind of UK usually flies under the radar a little bit, but the FTSE 100 finished up nearly 26% versus the S&P 500, which was 8% in sterling terms. So yeah, the UK market absolutely smashed the S&P this year for UK investors, despite the political uncertainty that's going on in the UK. As you all know, kind of the labour market's been driving a lot of wealth outside of the country, raising taxes and kind of backtracking on a lot of manifesto promises. Rachel Reeves is frequently kind of speaking about growth in the UK economy, but she's extended things like the VC program to kind of help small UK businesses grow. However, there was a recent survey done by Bloomberg that found that nearly 1/3 of UK small businesses are expected to downsize, sell, or close in the next year, which is kind of obviously a record high, and then does highlight some concerns of how fragile the health is of the UK consumer, with kind of weak confidence and then rising tax burdens. But there was a little bit of good stuff, because obviously it was quite negative heading into November where we had the budget, but the market response to the budget was fairly good. But this kind of can be down to stories leaking in the run up, people were fearing the worst, gilt yields were rising, and then domestic stocks were falling. But an interesting trend we saw during 2025 was the FTSE 100 has benefited massively from the capital reallocation out of the US, but it's a little bit kind of misleading as the FTSE 100 mainly consists of international businesses. Whereas if you look at the FTSE 250, it has more domestically focused businesses, which have significantly lagged the main index. So yeah, the FTSE 100 has a return of around just under 26%, and the FTSE 250 came in at 13%. So it does suggest there is a lot of concern over the strength of the UK consumer, as we see kind of wealth moving from the UK to lower tax regions. But yeah, interestingly, right after the budget, we saw a bit of a reversal from this. The FTSE 250 rallied the strongest, gilts rallied, and then in last place, FTSE 100. So a little bit of reversal as kind of sentiment changes. Investors naturally do like certainty. So yeah, a bit of a rebound there. But yeah, wealth continues to leave the UK. We kind of see it in the top end of the property market. Premium property prices are down nearly 20% in London, and are likely to worsen with the new mansion tax coming in. But despite the concerns and kind of highlights, so the UK continues to be an area that market kind of investors look for value. We currently have an overweight to UK equities in the portfolios and benefited us massively during the year. And it isn't because our thesis is the UK is going to be a great economy, it's going to be booming. It's not like at all kind of anything special in terms of a macro point of view. But this year has been about what you've held outside the US. Have you seen that kind of capital reallocation? Our exposure runs at about 14% in the portfolio, so reasonable overweight. But yeah, once again, looking at these kind of P multiples, you can see the UK offers great value and hence has outperformed the likes of the US. But just kind of following on from that, our exposure does consist of these large international businesses, which aren't massively impacted by UK politics. So we remain confident in our UK exposure. Then, as well as that, we do have a kind of a small position on looking at UK small caps. It's an active manager, so it's kind of quite active in that front and finding these niche opportunities that do exist in the UK market. But yeah, we saw during 25 that the large cap did take most of the capital, so there is kind of a potential kind of catch up there. So looking on to our outlook, so obviously US policy has been a very difficult thing to predict over the last year. Kind of the unpredictability is a regular occurrence now, and if you've been on the wrong side of it, some kind of people have struggled a little bit. But yeah, Trump being Trump wasted no time into 2026 of making headlines after we went and captured the Venezuelan president. And then on the back of this news, we've seen defense stocks rally very aggressively. And then yeah, kind of looking at Venezuela. The country is estimated to hold 300 billion barrels of oil, which is kind of at current Brent crude prices, that could be worth 18 trillion. So the largest result reserves in the world. And then next in line is Saudi Arabia, 270 billion barrels. So you can see kind of the way that Saudi has used this kind of strategic value of their resources and how they've kind of have this resource wealth and transform it into kind of an economy, which is hopefully what Venezuela could do. They're in a position where they could do that, but there's just a hope that with proper governance, kind of infrastructure investment, the Venezuela oil sector could lift many people out of poverty there. But in the interim, the US has taken control of the country, just kind of waiting until the new government can be formed. But Trump's been quite vocal that he does want US companies to have a share of oil production. So yeah, it's kind of a lot of different speculation of what the incentives were for the capturing of the president of Venezuela. But yeah, Trump said that oil majors going to go into there, and then as a result, kind of first day trading back since the capturing. Chevron was up 7% on the day, as it's the only country with existing operations in Venezuela. So this kind of move does help Trump's agenda for lower oil prices. Prices fell on the news, but however, building out oil infrastructure takes years to kind of to increase that barrels per day produced, and then it's also setting quite a dangerous precedent for the likes of kind of China and Taiwan, Russia, Ukraine. So there's a lot of kind of uncertainty, kind of tail risk to be from that. But yeah, moving on to China, Mo kind of mentioned China had a strong year, benefited us very well. But kind of in terms of outlook, the main concern is China's position in the crosshairs of the US. Trump's always been quite vocal about what's going on in China, but tension seems to have cooled for now. China's continued to strengthen its economic position, which is good. They've actually been increasing their total exports despite significantly reducing exports to the US. So the government remains in a very strong position, we think. They have room for additional stimulus. Inflation remains very low. And they've just kind of commenced the new China 5-year plan. They're focused on things such as like innovation, technological self-reliance, and the development of the domestic capabilities. And then kind of reflecting this in portfolios, we added the Hang Seng Tech Index during the second quarter of last year. So yeah, we're in a well-positioned kind of way to capture this shift, and there is still value in the market despite the kind of 2 years it's been doing very well. So now kind of touching on AI, obviously it's a very hot topic and sentiments kind of change throughout the year. It's very mixed at the moment, but yeah, it's just worth kind of looking a little bit deeper into kind of what's going on in the AI sector. One thing we're noticing is there's a lot of increase in leverage within AI startups, and it's beginning to alarm investors. GPU Loans was a newly established company, and the interesting thing with this company is they offer 100% loan to value financing, and then it's fully backed by the private credit sector. So the idea that private credit can help fund the data center rollout, but what this is doing with this much leverage is adding a lot of systemic risk. Unprofitable AI companies are taking on 100% LTV loans secured against GPUs that depreciate within a couple of years. They've kind of been a bit funny within the books of kind of depreciating over 5 years, but realistically it's going to be 2 or 3. And this is on the fact that Nvidia releases new GPUs every 18 months, making previous ones completely obsolete. And yeah, like I said, they're being financed with debt, which could leave private credit investors quite exposed if AI profits fail to materialize, which they still have not. And then if borrowers do default, lenders are going to take possession of the GPUs, but there's no liquid secondary market for those GPUs. So businesses generally aren't going to want used GPUs, and the technological kind of advancement is just going to make replacing them kind of even worse. You're going to want the newest edition, just like the iPhone every year. People are going to want the newest one. They're going to keep churning them out, and Nvidia is going to be kind of making money off that. But yeah, this could become a significant problem over time. And then also the fact that there's a lot of kind of hype around AI, especially AI spending. We've seen that kind of when a company announces AI spending for every $1 of AI investment, your market capitalization can expand by up to $3 worth for every one, without any regard to the revenues produced from the spending. So it's causing a little bit of concerns. But this is changing a little bit. More on the fact that the Mag 7 have kind of led investment. They have strong balance sheets, huge cash reserves, and that allows them to kind of fund spending internally rather than issue debt. But then we saw Oracle announce kind of large AI spending plans. Its share price surged 40% in a single week. Larry Ellison became the world's richest man. However, we saw last quarter their Q3 earnings was reported and missed expectations slightly. And because of this AI investment was debt funded, the market reacted very negatively. The stock subsequently fell 43% from its peak, so a huge decline there. And it's kind of a warning sign to these kind of large companies that want to do AI capex that kind of, if you're going to do it debt funded, it's got to be you've got to have a return on investment on there. Whereas if it's cash, it seems the investors aren't too bothered by that. But yeah, looking on some more concerns, there was an interview that the CEO of Microsoft did where he kind of admitted that thousands of GPUs are sitting idle in data centers because there isn't enough energy to run them. The main concern with AI isn't that there's not enough computing capacity, it's more on electricity and space, as these data centers require enormous amounts of energy, and the most developed economies are struggling to kind of expand their power grids, kind of adding additional capacity does take a long time, and governments are unlikely going to be the ones pushing this. And this is kind of likely where private credit will come back in and fund the expansion on this, but it's already facing its kind of own risks that I touched on. But yeah, I've been doing a bit of kind of reading, and you can see that I think in terms of capacity, spare capacity, Middle East seems to be the most likely place where you can go kind of do this AI data center rollout. Some investors are looking at renewable energy as a potential solution, but it's not really yet proven that there's going to be enough power to scale kind of AI data centers through renewables. But despite that, uranium stocks have been surging. But yeah, it's not really yet been proven. But yeah, kind of G7 governments are now facing kind of a tricky dilemma where they've committed to these ambitious carbon emission targets. But if they want to kind of meet the additional energy demand through this kind of AI drive, they're going to have to kind of maybe pivot to fossil fuels to try to help that, as there's kind of a quickest way to get those kind of productivity boosts that a lot of governments are looking for from AI. But yeah, it looks like the private credit market is going to be very dependent on this next shift, and the cracks are starting to appear there. And then yeah, something else there was that was noted that a lot of the space companies are now looking to see how they can kind of fit into the puzzle here. And then people are looking at potentially building data centers in space that tackles the problem of cooling. Not too familiar with how exactly it will work, but yeah, there's thinking of kind of anything there. But yeah, there's still kind of a perception of an AI bubble risk that's focused in US tech, more specifically the Mag 7. They now account for 40% of the total market cap index, the S&P 500. So a huge amount. And then yeah, there's definitely a bubble risk there, as we kind of saw maybe during the 2021 kind of post-COVID rally. But the main difference was back then in 2021, you had zero interest rates, which allow firms to grow into their expectations by investing heavily with very cheap money. But now it's very different, where large tech companies aren't really able to borrow large sums of money. This is where the Mag 7 are in kind of their unique position, where they have huge cash reserves and strong free cash flows to fund new projects. But yeah, lending ability is now tightened, as profitless tech is now considered a very large risk to banks, and banks are kind of more unwilling to go there. And then what this does is just force the smaller firms to be kind of acquired by larger competitors, or they just issue equity in that way. And then yeah, Mag 7, based on that, Mag 7 are now going to be kind of the front runners that they've always been. It's very expensive kind of capital expenditure there, so they still remain in the driving seat. But yeah, competition is very intense between these AI companies. You've got so many different options. So you've got ChatGPT, the main one, Perplexity's there, Grok is now there, DeepSeek we saw last year. So it makes it very difficult to raise prices. A lot of them are free. And then let's say if ChatGPT tomorrow wants to make everyone pay 20 quid, you're probably just going to go use another one instead of pay it. So they're in a difficult position there. And then, yeah, another concern is the interconnectedness of all the AI businesses. And then, yeah, how reliant they all are all on of each other. So, example, we saw OpenAI received $100 billion investment from Nvidia last year, but yet it continues to burn billions annually. And they've kind of said that they don't really expect to be cash flow positive until 2029. And that's even as they were the first mover in that space. They're just struggling to generate profit and revenues to kind of meet their costs. But what complicates this kind of further is the interdependentness of these tech giants. And then if one falls, there's a risk that the others are likely to follow, as they're all each other's customers. And then yeah, the $100 billion investment is largely aimed at OpenAI buying more NVIDIA chips, which creates this self-reinforcing cycle. And you can see the chart on the right there, just kind of all the different kind of money flows and the reliance AI companies have. And this is all with NVIDIA at the epicenter, as they're the only company really yet to produce profit from this shift. But yeah, it's been reported that Sam Altman, the head of OpenAI, has been meeting with US government officials to see if there's a possibility that they can gain a US government bailout if they were to run out of money. As their kind of thesis is the detriment of losing this AI race is far greater than spending tax dollars to keep them alive. But yeah, of course, the rumors and nothing yet confirmed by either side. Labour market data is showing a little bit of weakness. We've seen kind of fewer new job openings, but even though the US economy remains resilient as consumers stay strong, there is heavy debate about how AI will reshape the job market as firms look to replace jobs, kind of let's say lower skilled jobs through AI integration. And you can see the chart on the left there. It's an interesting one that kind of went around. You can see the multi-decade relationship between the S&P 500 and the total amount of US job openings. And you can see there's a visible shift around the time ChatGPT was released. And then there, the question is now that the Fed are cutting rates and they put it down to a softened labour market, if there is kind of a weaker labour market, is these rate cuts going to meaningfully stimulate job creation? And this is currently what Powell thinks, but in reality, it may not be the case. So now moving on to kind of talking about leverage, adding kind of risks into 2026. So yeah, in 2025, we saw a lot of market euphoria as asset prices rallied very strongly, and then a lot of leverage was taken on. But we saw this was mainly being done by retail traders in the US, and it was kind of shown when there was even the smallest of sell-offs. These are very exaggerated with the excessive leverage, people closing out, just magnifying any sort of kind of news trigger. Backed on that, money's been piling into meme stocks, pumping up crypto schemes, and then just yeah, risk appetite has just majorly gone up during 2025, and it's worked. A lot of asset prices have been rallying strongly. But yeah, we can see these risk-loving traders in terms of the retail space using leverage up to 50 times, and you can look at margin account data, and then yeah, on days where the S&P sold off just by a couple percent, a large number of accounts you can see completely wiped out. There was one account you could see that was down in the red by $19 million, just levering up too much, kind of betting the house on a single stock, and then things to go against you. And then yeah, a lot of analysts have been reviewing this account activity. And something quite interesting you're seeing is kind of could be potential insider trading going on. It was roughly when Trump released that tweet, or truth you could call it, on the right there. There was a brand new crypto wallet that was open 30 minutes before that post went up to threaten more kind of tariffs on China. And this person took a hugely leveraged Bitcoin short position and made $89 million in that day just on a single trade. So yeah, some odd things going on there. We saw another one where OpenAI announced a 10% stake in AMD, and then just before a retail trader brought six million worth of AMD options and made $18 million in those kind of couple of days. So yeah, a little bit strange, a lot of kind of greed, euphoria, just some kind of red flags to look out for. But it's not only on the retail side, we've seen institutional leverage creep up slightly, especially amongst the hedge funds. A survey was done where they said 75% of the largest money managers believe we're in a kind of a high risk on environment, and this will continue into this year. And then over the last 2 years, we've seen a lot of very short-lived drawdowns. You can go kind of rewind back to April. Kind of you see these huge sell-offs, and a lot of people have been dip buying. A lot of hedge funds have been driving a lot of the movement, as that's very news-based selling, which kind of scare retail investors, try to get them involved as well. Still, hedge funds remain kind of a large part of daily liquidity. They're highly reactive to news, so it's going to come kind of with the territory. And then when bad news does come out, they seem to all rush for the exit at the same time. So it creates a little bit of systemic risk heading into this year, which we're kind of aware of. But yeah, it kind of ties back to that quote there from Charlie Munger. I'm sure you can all read that. Yeah. But yeah, kind of previously mentioned the meme stocks and the crypto pump and dump schemes. So yeah, there's a lot of leverage. Euphoria is high, and then back in October we saw kind of Beyond Meat making the headlines. So for those who don't know, Beyond Meat is the kind of vegan artificial meat producer. They IPO'd back in 2019 and surged nearly 500% in its first few months. So a very popular stock, but as people kind of gradually realized the fake meat didn't taste as good, there wasn't a huge market for it. Customers weren't too interested. The stock went and fell 99% over the following years. The company struggled to grow, and many hedge funds were shorting it successfully, and it actually became the most shorted stock in the US. And being that kind of most shorted stock, having kind of recent presence, like people kind of know the name, it made it prime target for these meme stock traders. So yeah, they started kind of having that momentum, buying up the stock, and then the hedge funds are very kind of on this now after what happened to GameStop in 2021, where if they've got short positions and they notice retail traders very active there, they'll kind of get out before things turn too bad again. So all this did was closing out the short positions, drives up the price even higher. And then there's a meme stock ETF by Roundhill. They kind of caught onto the news and brought Beyond Meat into that, and then it became kind of an internet thing again, as we saw with GameStop. So yeah, back in October, Beyond Meat was up 12x in just 5 days. So yeah, huge rally. So you can see the power of this kind of meme stock momentum, kind of euphoria that's going on, kind of the risk appetite. But yeah, since then it's now returned to kind of short squeeze levels as we saw kind of a lost momentum. And then one more point on kind of on this irrationality, you can see in that picture, it's Jensen Huang, the CEO of Nvidia. He was photographed eating Korean fried chicken. Not a huge deal. But once the picture was released, the stocks of the Korean poultry companies rose nearly 30%. No fundamental reason for that whatsoever. It's not like fried chicken companies are going to need Nvidia GPUs, but yeah, a lot of strange stuff going on the market, kind of adds to this kind of potential risk heading into the year. But yeah, that's kind of everything to talk about today. I'll just kind of stop sharing my screen and try to see if there's any questions. Okay, so one question we'll look at. So what do you see as some of the main tail risks in 2026? Do you want to take that?
Main tail
Yeah, tail risks.
tail risks. Well, I think at the moment, despite all of the geopolitics, clearly that could be a potential issue that's rearing its head again as we come into this year. That, I mean, specifically around the Middle East and Iran. So the main worry around that is the oil price, and clearly, based on what Lucas said earlier, with what Trump's doing in Venezuela, I mean, his idea is to bring the oil price down, but there is a conflict there in that he clearly wants regime change in Iran as well, and that potentially could lead to oil price instability if the regime fought back. So oil potentially is something that may become an issue the oil price later on this year. A lot of what Lucas has talked about in terms of AI, I mean, this has been brewing for a while now, and I know Lucas has talked about this a couple of times in various ways. And we believe that it's just a matter of time before some issue turns up, and that has a knock-on effect across the technology space. with all of those sort of big players in the market and many smaller players. So we don't know when it's going to happen, but we believe that we're probably closer than we were 6 to 12 months ago to a potential issue coming along, particularly with the lack of revenues or profitability from a lot of these companies and the amount of cash burn that's going on. I would say they're the main two. At the moment, everything else seems to be sort of ticking along, and I think what we've seen is that despite what's been thrown at the markets over the last 12 months plus, they sort of shrug it off and keep going. So at the moment, everything seems to be okay. The labour market in the US most recently had some more positive data, in contrast to what we were seeing in the last sort of couple of quarters of 2025. So at the moment, that seems to be okay. Inflation is moderating. It's still higher than it used to be, but in the US and the UK, but it is moderating. So on the sort of macro side, there are no sort of big red flags or anything sort of overly concerning. I think it's just probably the way the markets are operating at the moment and market dynamics. So again, exuberance, a lot of risk taking, leverage, and the whole sort of AI train that seems to keep going at the moment. But we think at some stage an issue is likely to crop up in those areas.
Right, just looking at the Q&A chat. So thoughts on recent US tariff threats? I can take this one. Yeah, so it's something we've seen a lot over the last year. So yeah, what Trump did was kind of threaten a 10% tariff on all of Greenland's allies. I think it included about 8 different countries. So yeah, we've seen this kind of time and time again, and it gets to the point now where I don't think investors are taking a lot of the threats seriously. We saw a small sell-off today, but US markets are closed. We won't find out really tomorrow to what happens. But yeah, he goes in kind of all guns blazing and will kind of come back a little bit. He kind of talks a lot about that in his book. Was it The Art of the Deal? Was kind of go on at the start and then kind of retreat back a little bit. So yeah, I think a lot of people are starting to realize his style and kind of what that means. So I don't think anything material would come for that as of yet. We've seen that he does have his kind of pressure points, as we saw back in April, where if the kind of bond market starts sliding, he comes under a lot of pressure, and you've got that kind of Trump put, where he won't let things get too bad before he reverses his quite extreme policies. So yeah, I don't see it as a kind of full problem. Just one more question, looking at Q4 returns by fund. There was a slide on that, but we can send you kind of a chart after, just showing the kind of full performance.
Yeah, just to add on that, because the only portfolio that we showed was the growth portfolio, but happy to share others. If you could just drop me an email, we can come back with whichever one you want to see. And in terms of the actual returns shown in these slides, they are gross of fees.
Nice. All right, wrap things up. So thank you everyone for joining. Hope you enjoyed it, and have a good rest of your Monday. So thank you very much.
Thank you,
Bye, everyone.
Thanks for joining.